Welcome to the importance of cash flow. This is a very important topic, and we're glad we can bring it with you to you today. We have our own presenter, Jim Dannhauser with Score Cape Cod, and we have two representatives from Middlesex Bank to take all your questions today. We'll get into more about that, but we want to start off with what Score does and what we offer. We want to make sure that you're taking advantage of everything that we have to give to you. Our goal is to share small business information, and we do that in several different ways. One is from our website, score.org. You're going to find lots of great information, templates to download, podcasts, blogs, recorded webinars to watch, lots of great information. So, feel free when you got a few minutes to dig through the website and see what you can find there. The other way we share information is through our workshops and webinars. And those are advertised via social media. They come out quite frequently on our newsletter. And of course, they are also listed on the website. I think the most important thing, or the most important way that we share information, is our mentoring. And our mentors are volunteers. They have a wide variety of experiences and knowledge, skill sets to share with the small business community. And you might wonder who we're working with in the small business community. Well, we're working with those that are thinking about trying to start a small business, are in that planning phase, are already in business, growing that business, and then perhaps exiting that business or selling off their business. So the whole pathway. So we strongly encourage you to consider a Score mentor if you don't already have one. A beginning session, they're going to want to learn about you, about your goals and challenges, and they're going to work with you to come up with a plan so that you're successful. It's not uncommon that your mentor may change along the way as your needs change, and they're going to make sure that you get the information you need because that's why they volunteer. They want you to be successful. So the next logical question is, how do I get that mentor? So that is very easy. There's multiple different ways, but I think the very easiest will be going to the score.org website. There is a let us do the matching for you box where you just put in your zip code, and that will match you with the chapter that's nearest you. It'll pop up a form, couple super quick questions. We want to know a little bit about what your business is, what stage you're in, what kind of help you need. And then we'll use that information to match you to the mentor within that chapter so that they can help you. Today we are recording, and that recording will be posted on the score.org/Boston website. Under the, if you can see from the graphic, under the local workshops pull down previously recorded section. We will also do a follow-up email to all those that are attending and give you that link as well so that you can rewatch the presentation today if you'd like to. We will be utilizing Q&A tab on the Zoom bar. That just allows me to keep track of those questions. We will try and answer some during the presentation when applicable, and the rest at the end. So we're going to go ahead. Let me pull this down one moment. But first, before we get started, I do want to introduce our sponsors today. We have David Bennett and Jeff Homoliski today with us from Middlesex Bank. They're going to be able to take any of your bank-related questions at the end as well. So, but I think David would like to say a few words.
Well, thank you, Teresa, and good afternoon, everyone. I'd like to thank you all for taking time to join today's webinar, and on behalf of the bank, we're certainly delighted to be today's sponsor. For those of you that don't know, Middlesex is the largest independent bank in Massachusetts. And by independent, I mean we're a mutual savings bank that was founded way back in 1835, and we have no shareholders. This is an advantage, I think, that allows us to take the long view and to focus on our customers and the community while not having to answer any shareholders. Now business owners like yourselves, you come to Middlesex to, so we can help you solve your challenges such as cash flow, funding of growth, investment in people, equipment, and processes. You also want to partner with someone that works with a business just like you. One community business to another, we like to say. And our bankers will take the time to understand these issues work with you to help solve them, and then be part of your team as you grow. Today's webinar on cash flow is a topic that's critical, very critical to the success of any business. We can say that because we see the need every day. And then there's no one better, really. SCORE is the perfect partner to assist in explaining this important aspect. And as a longtime supporter of SCORE, they're one of our go-to organizations. They got a long track record of helping businesses plan to succeed. So I hope you enjoy today's webinar and you walk away with some ideas and lessons from Jim that you can make your own. So enjoy the time. Take care.
Thanks, David. Now I'll go ahead and turn it over to Jim.
Thanks, Teresa, and good afternoon, everybody. My name is Jim Dannhauser. I'm a volunteer with the Cape Cod and Islands chapter of SCORE, and I'm here today to talk about cash flow management for small business owners. It's a critical topic and one of the most important things that you need to pay attention to in connection with your business. By way of background, I started my career as a commercial attorney at a big law firm in New York City, then moved into investment banking, serving as a financial advisor to big and small companies, and especially to a family that owns several small businesses. I eventually joined the board of one of those companies, became its chief financial officer, and we grew that company and ultimately took it public. I stayed on that, involved with that company for about 15 years, and then moved on to serve on the boards of several other public companies, and then as a senior advisor to a big private equity firm. After that, I, with the partner, invested some of my own funds in a couple of small businesses that we've successfully exited from. So a long way of saying that I have seen the life cycle of small businesses from a number of different perspectives, and have seen quite closely just how important paying attention to cash flow and liquidity is for a small business. One other thing before we get started, one of the negatives about doing these things virtually is that you lose some of the personal contact with your audience. So I would encourage you, as questions occur to you, to put them into the Q&A. And Teresa is going to follow those and pose them to me as they come across. And that way we can each replicate some of the dynamic that you get in a more in-person conversation. So with that, let's dive in. What are we going to try to cover? Well, I'm going to give you a brief overview of financial statements. I'm not going to try to make you an accountant, just try to have you understand the basics of what financial statements are and what they can show you. We'll touch also briefly on startup costs and budgeting, but spend most of the time on cash flow statements and on forecasting and managing your liquidity. So what's the objective of a financial reporting system? It's very simple. You should have a financial reporting system so that you are in a position where you gather accurate and complete information in a timely basis about the financial status of your business. You need that in order to be able to make smart, good decisions about your business on a going forward basis. I don't care whether you have an online system like QuickBooks or others, or you keep your books much more simply. You need to make sure that the information you are relying upon is accurate and complete. Because if it's not, you can put yourself in a position where you make bad decisions or fail to act appropriately. And do avoid garbage in, garbage out. Information has to be complete and accurate, or you'll be positioning yourself to not succeed. So what are the basic financial statements? First one is an income statement, also often referred to as a P&L. What that does, it shows the operating results of your business for a specified period of time. Typically, it will be a month, a quarter, or a year. It just shows the income and loss and what the net operating statement of the business was for that period of time. A balance sheet, on the other hand, is a snapshot as of a particular date. It may be the end of the month, it may be the last day in a quarter or the year. It shows what the business owns, what are its assets, and what it owes, what are its liabilities. Now, some people sometimes ask me why it's called a balance sheet. Well, that's because the two sides of the document have to balance. The assets, which are on one side, have to equal the sum of the liabilities and the equity. If your assets exceed liabilities, you have positive equity. If your liabilities are greater than your assets, you have negative equity, but they always add up. And they just show you what the state of the business is on a particular date. A cash flow statement is very simple. It shows all of the cash that came into your business and all of the cash that went out of your business for all purposes and uses over a defined period of time. Again, whether that's typically a month, a quarter, or a year. And we're going to spend most of our time today talking about cash flow statements. There is another important financial document, which can be called a budget or a forecast. That speaks to what is expected to happen in the business over the next period of time. And we'll talk a lot about cash flow forecasts today as well. Just a minute on startups. All startups should prepare a cash flow budget, showing the cost of developing and planning and getting ready to operate. And it should also show the cost that you expect to incur for an initial period until you reach break even, which could be as long as 6 to 18 months. Break even meaning when do your revenues in cash exceed your expenses in cash. And you should also include a contingency when you plan for a startup. Because in the history of the world, I can promise you that virtually nothing has ever gone exactly as it was planned. And if you don't have a contingency, you can find yourself in a position where you come short of the cash that you need in order to get your business up and running successfully. Now, SCORE does a bunch of webinars that focus more exclusively on startups. If you're in that position, I would encourage you to go to the score.org website and search through the existing webinars that have been done nationally and by chapters throughout the country on that topic to get the specific help you need. And you can also reach out to a SCORE mentor in your chapter who can also provide you with the appropriate resources. Okay, cash flow statement. So what is cash flow? As I said, cash flow is a very simple concept. It looks at all of the cash that came into your business from every source imaginable, whether that's cash sales made, collection of receivables, you may have gotten the proceeds of loans or investments, you may have sold some assets. So all the cash that came from whatever source will show up as an incoming cash flow. Outgoing cash is everything that goes out of your business for any reason. Operating costs, debt costs, buying assets, buying inventory. So that's what cash flow is. The movement of cash in and out of your business. And the cash flow statement, as I said, looks at those inflows and outflows over a specified period of time. You should be looking at your cash flow statement frequently, at least as often as monthly. It's the only way to know where your cash is coming from and where it's going. I have a colleague who said to me that in his view, the owner of a business has two non-delegable responsibilities: overseeing sales and revenue generation and watching the cash. What's also important to know is that you could look at your P&L and be operating at a profit, but still be running a cash flow negative. Why? Well, you may have bought assets that are going to be depreciated over time in your income statement, but the cash went out the door when you bought the asset. You may have generated sales, but have a lot of receivables that haven't been collected. So don't think that just because you have a positive P&L that you're in a cash flow positive position, because you may not be. So how do you prepare a cash flow statement? Well, most of you, I would assume, have some kind of accounting system in place, whether that's QuickBooks Online, Waze, or some of the others. And there are many. And if you're looking for recommendations about accounting systems, you could talk to your SCORE mentor. You can look online. Many people use QuickBooks Online, for example. And that's a very good system to use, whatever your accounting system is, because it generates a cash flow statement quite easily for you. You don't have to figure out the accounting that goes into it. You can just look at it. If you want to dive a little bit into it, well, you can look at that blog that's referenced there. It's a good blog that actually explains how cash flow is calculated. And if you want to do that, you can maybe better understand what your cash flow statement is telling you. It's worth a little bit of time. You can also look at score.org. There are templates that'll give you a form that you can fill, which will give you a cash flow statement. I'll give you show you how that looks like. And Teresa, can you see that?
Yes, absolutely.
Okay, great. So this is available to you on score.org. It is a template you would fill out to get a cash flow statement. Every time that you look at a cash flow statement, you will always start with what is your cash balance at the beginning of the period. And then you can see this picks up all of the cash receipts in the period. It picks up every cash dollar that went out the door during the period, including some what we would call below the line outflows like payments of principal on loans and capital purchases. Total cash paid out, and it comes to a cash position at the end of the period. So that's a very easy form that you can use to generate a cash flow statement for yourself. Here's an example of what a cash flow statement typically would show you. Again, always look at the cash at the beginning of the period. You see what the total cash flow was and the cash at the end of the period.
Hey, Jim, could you zoom in on that just a little bit? It's a little bit small. On the bottom corner, can you do 100, make it a little bit bigger? Oh, that's so much better. Thank you.
Okay. Accountants will divide your cash flow into separate buckets: operating activities, investing activities, and financing activities. Why do they do that? Well, it helps you to understand where your cash is coming from and where it's going. So operating activities pick up all of the cash that comes in from your regular operations and all the cash that goes out. And you can see the examples of them there, of the types that you would see. You would see cash from investing activities, which means what equipment or other assets, capital assets, did you buy that don't hit your income statement right away? What assets did you maybe sell? And then also cash flow from financing activities, which are bank borrowings, investments that you receive, bank principal paybacks. Why do I focus on this for you? Because it's helpful when you look at a cash flow statement to understand these buckets, because they can help you to analyze and understand better what is driving your cash coming in and what is driving your cash coming out. Okay, well, with that overview covered, let's talk about cash. You've heard a million times, I'm sure, that cash is king. There's a reason that things become truisms. It's because they're true. Cash is king, and particular for small businesses. Most failures for small businesses can be traced to liquidity or cash flow problems. Running out of cash is death for a small business. You don't have as many levers that you can pull as a bigger business might have. So it's very important that you stay on top of your cash resources and anticipate your future cash needs in order to avoid a liquidity crunch. I used to tell people that worked for me that we could survive anything and live to fight another day so long as we didn't run out of cash. And that is really true. You need to make sure that you stay on top of your cash resources at all times. There are some simple things that you can do that can really help. If you walk away from this with nothing else and you don't already have it, I would hope that you would make sure that you create a separate bank account for your business. It's a very important step. It's a very easy step to take. You run all of your receipts and expenses of your business through that account and none of your personal expenses. Why? A lot of reasons. First, it's the easiest way for you to monitor the actual cash position of your business. Every bank that I'm aware of now has online portals. You could go and just check quickly what the cash balance is. You can see what cash has come in. You can see what cash has gone out. So it's a very easy way to monitor the actual cash in the bank of your business. It also is a way that you can make sure that you understand the actual health of your business from a cash perspective. I've had clients who didn't do this. And trying to separate out all of the personal expenses and the business expenses became a bit of an administrative nightmare. So just make sure you keep a separate bank account for your business and use it for that. And if nothing else, your accountant who prepares your taxes will be very happy you do that, because it makes tax preparation a lot easier, and it makes sure that any deductions you have that you're entitled to, that you actually take. I would also advise that you consider keeping a separate credit card for your business if possible. Use it only for business expenses and not for personal. Why? A couple of reasons. First, you begin to establish credit for your business. Secondly, you may come to times where you need to buy something, whether that's inventory for a sale you're having, whether it's a particular piece of supplies, and you don't have the cash available immediately, nor do you have other financing available. Well, that credit card can become the vehicle that you can use to accomplish that transaction. I am not advocating that you do that extensively. And I also do strongly recommend that if you do it, you pay it back just as soon as you can, because credit card rates are very high from an interest rate perspective. But it can be a tool that can allow you to do certain things for your business that you may not otherwise be able to do. People sometimes say, well, can I use a debit card to accomplish the same thing? And the answer is really not, because a debit card only works to the extent you have cash in the account against which the debit card is being drawn. So a credit card is a very valuable thing to have. And yes, it can come with some fees associated with it, but those fees are well worth it for your business. You should always look at your cash flow statement frequently, at least monthly. I'm going to talk a fair bit about a cash flow forecast. You should make sure that you keep one in place for the succeeding 12 months and keep it updated, because things change. And you need to take account of those changes to make sure you stay on top of your liquidity needs. And when you're making decisions about your business, do it with the impact on that cash flow forecast in mind. You should maintain good accounts receivable collection practices, and we'll talk some about that later. And you should avoid overdoing it on supplies, inventories, and equipment. Those kinds of purchases eat up cash. Now, I know that everyone wants to have the supplies that they need, the equipment they need, and if you're a retailer, the inventories that you think you need. But do avoid overdoing it. Many times retailers overbuy inventory, and that sucks up their cash until that inventory is sold. So be careful to not overdo it. All right, talked about having a cash flow forecast. You should be doing a budget every year, and you should prepare a cash flow forecast for that coming year as part of that annual budgeting process. But don't just prepare it and stick it on a shelf. You need to look at that forecast from time to time, at least as frequently as monthly, because things change, things happen, and you need to reflect what actually happened and then anticipate what will occur over the intermediate term and over the next 12 months. Why? Because you're going to need to make decisions about your business. If you have a significant downturn in sales for some reason in a particular month, you need to reflect the impact of that in your cash flow forecast. You need to anticipate, is that going to continue? Why did it happen? You may need to make changes to your business structure if you see a downturn in revenues. Reduce expenses. Consider staff reductions. Maybe perhaps defer paying yourself for a period of time. Always make sure that you're looking at your forecast and that you keep it up to date to reflect changes that occur, because things do change. And you can't make smart decisions about your business unless you can see what your cash situation is going to be over the succeeding 12 months. If you have a business downturn, do I need to lay people off? Do I need to otherwise reduce expenses? Do I need to hire people to take account of increased revenues? Do I want to take on additional work? A lot of people miss the fact that when you take on work, typically you're going to incur additional expenses before the revenues from that work are generated. And so you need to be sure that you can handle that inside of the cash flow that is in your business. And you always got to bear the seasonality of your business in mind. We're hyper-focused on this on the Cape because it's a seasonal business. And I've seen people who are very happy in June, July, and August. Things are going great. But at least in my experience so far, every year has also had a January and a February and a March. So make sure that you understand in the seasonality in your business, which may be different than others, and that you understand what the impact of that can be on your liquidity needs. And if you see a cash shortfall on the horizon, don't wait. Take steps to deal with it early. And we'll talk about some of the steps that you can take. But you could seek working capital, facility, or other loans. You could reduce unnecessary expenses. You could delay purchase decisions. All of these things have to be considered if you are going to be stretching your cash resources. Now, for near-term issues, you might consider meeting with parties that you owe money to and explain the situation and when you think payment will be made. You have to be very careful with that because you don't want word to get out that you're having liquidity problems. You can have difficulties with suppliers if that begins to happen. You can have difficulties with competitors trying to talk you down. But if you have a particular cash flow crunch, you may need to speak to one or two of your creditors to explain what's going on. And you should always try to establish some level of cash reserves and or establish a working capital line of credit to help you deal with shortfalls. Now, what is a working capital line of credit? Well, working capital is a fancy term for current assets as compared to current liabilities. Current assets are cash, receivables, inventories that can quickly be converted into cash. Current liabilities are your accounts payable and any short-term debt that you have. And that's what working capital is. To the extent you have positive working capital, it's because your current assets are greater than your current liabilities. If you have negative working capital, that's when your current liabilities are greater than your current assets. A working capital line of credit is an arrangement in which a bank agrees on your request to lend you up to a certain amount of money. It can be any particular amount. It may be $5,000, it may be $10,000, it may be $25,000 or $50,000. And that is available to you on demand as you need it. You'll pay a fee for it. And the loan has to be, obviously, the credit facility has to be approved by the bank. And typically, you will have to what we call clean it up, which means reduce it back to zero and leave it at zero for at least 30 to 60 days inside of a 12-month period. But having that in place and paying that commitment fee can be a very valuable resource to you if you run into some cash flow difficulties, because you can call on the bank and get the money.
Hey, Jim, is there a target for that cash reserve? Is it a percentage of your monthly or annual revenue, or how do you decide what's?
Well, obviously, you want to have as much as you can, which is kind of a glib answer. But you would think about it in terms of what is your annual expenses, your monthly expenses. So if you had a cash reserve that was at least equal to 3 to 6 months of operating expenses, then you've given yourself some flexibility to deal with unanticipated issues.
And where is I believe so, yes.
Okay.
Where's the cash reserve accounted for in the budget?
It would just show up. Well, you would establish a line item for cash reserve. And as you contribute to it, that's where it would show up. And it would show up on your balance sheet as cash.
Great, thank you.
Okay. So I wanted to take a minute looking at cash flow forecast. You'll see a reference down at the bottom to, Teresa, can you see this forecast?
Yeah, yes.
Okay. You see the bottom, I have a reference there to a YouTube video. I'm a big believer, if you have questions about things, to go use some of the search engines that are available. You can find tremendous amount of information. Some of it you have to be careful about, but some of it's quite good. There's a YouTube video, how to accurately project your cash flow, your complete guide. It's very good, very simple, and is a very handy way to put yourself in a position where you can establish one. This is a cash flow forecast that shows, again, you've got the beginning cash balance of $20,000. The numbers aren't important. What's important here is the story. This business ended up with a cash balance of $11,000 because it had $9,000 negative cash flow for the year. Cash went out of $709,000, cash came in of $700,000. That's okay. You still got $11,000 in the bank. But you can see here that in March, they suddenly had a negative cash balance. How did that happen? Well, the biggest thing, if you look at it, is that they bought a significant amount of inventory gearing up for the season. If they had known that they were going to have a negative balance by the end of the first quarter in cash, they might have done things differently. They might have bought some of that inventory on credit. They might have delayed some of that inventory purchase to get closer to the operating season when revenues were flowing in. Or if they had a working capital line of credit, they could have taken advantage of that. But if you didn't have any of those things and you didn't have the cash flow forecast, and you went out and spent that $40,000 for inventory over a 3-month period, you would put yourself into a negative, which could give you a problem. Again, come June, there's a $4,500 negative. Not the biggest number, but it's a negative, and you have to be able to deal with it. How'd you get there? Well, look, they bought $20,000 worth of equipment. Now, if they knew that that was going to put them in a negative position, they might have tried to do something different. They might have, for example, tried to buy that equipment on credit. And many times you'll find that equipment sellers are the most ready form of financing for small businesses because they're accustomed to being in a position where they provide credit for equipment purchases. And they're comfortable that if the loan isn't going to be repaid, they can, in fact, take the equipment back and have it as part of their own inventory to sell. Let's suppose, for example, in addition to those obvious things, let's suppose that suddenly in May, instead of $70,000, the business only generated $40,000 in cash. Well, now their negative is much bigger. The first thing they should be doing is going in and looking at what actually that means for the rest of the forecast period. Because if they suddenly drop there must be something going on, and the balance of these forecasts may not be accurate. They also now have larger negatives to deal with. They may need to come in and think about reduction of other expenses. They may need to defer advertising, for example. If you dig into the other expenses here, you'd have advertising expense, you'd have other expenses that are going on. They may need to consider reducing their labor, or they may need to defer taking draws themselves. The point is that things change during the course of a forecast, and you have to take account of that change and make whatever modifications to your business that you can make in order to survive, because running out of cash is a death for a small business. Accounts receivable. This is a big issue for many small businesses, and it can cause as many liquidity problems, in my experience, as almost anything else. Now, if you're in a business that a retailer or other business that doesn't generate receivables, that's good. But if you're not, if you're in a service business and you generate receivables, you need to make sure that you develop and maintain good practices for dealing with your receivables. What do these include? Timely billing is probably the single most important thing that you need to do. I've had clients who just didn't do it, but you need to get the bills out as soon as the work is done. You should clearly state what work has been done, what's owed, and when the payment is due. Now, there are a myriad of invoicing tools that are available to you to do this, and they are very effective and not very expensive. And many of the accounting systems that small businesses use have their own invoicing tool built into it. and get it done very easily. I would advocate that you do that and use those systems because they make it much easier to track payments efficiently. They integrate with your accounting system. You can pull up and do an accounts receivable view to show you who's paid and who has not. And it makes your management of the receivables much more simple and much less painful. You should send out bills by regular mail as well as by email. That way you can be sure that they are actually getting to the people who owe you the money. You ought to make it clear how checks should be paid out and where they should be sent. And you can add instructions now for online paying or by credit or debit card, if applicable. Most companies can now access those kinds of processes through various means, and they're very helpful and can eliminate a lot of pain with getting collections of receivables. People will sometimes say, well, I have to pay fees if I do that. And yes, you do. But you're freeing up time from having to deal with receivables. You're freeing up the risk of having to chase people for them. And it's money that is very well spent on a going forward basis. I would also suggest that either you or somebody on your staff get to know who actually makes the payments at your customers. Communicate with them regularly, because that way you can reach out and make sure that you're sort of at the top of the list of the people who are going to get paid. You should monitor your collection processes. Make sure you get reminders out when payments are late. How do you monitor the collection processes? Well, if you have your accounting system, you can run an accounts receivable aging analysis, which will show you what accounts have not been paid for 30, 60, 90, or longer periods of time. If bills aren't being paid, you should reach out by phone and email to make sure that you're getting your money, because it is your money. You don't want to be overbearing, but you want to make sure that you strike the right tone that you should get paid. Now, if you have serious delinquencies, what do? Well, you can send a formal letter demanding payment. Don't threaten. It's just an effort to collect. And you can also consider, if you wish, legal action, including going to small claims court. I have a client who insists that if people don't pay on time, they take them to small claims court. They want to get paid, and they want people to know that they are going to get paid and that they will not tolerate not being paid. That's a matter of what business philosophy you want to have. Many people don't like doing that, and I understand that. So you deal with it as best you can. Also recognize that there is an expense involved, even in small claims court. If nothing else, it's your time. So I would suggest that you might want to consider checking the ability of whoever owes you money to actually pay. Most people don't want to skirt payments of their obligations, but they may not be able to meet their obligations. So be prepared to cut price and collect what you can before proceeding. And by all means, do not continue to do business with customers who simply don't pay you. You have to be prepared to fire a customer if they simply aren't paying you on a timely basis. You might also consider early payment and prepayment discounts. Now, I've had some people suggest they don't like doing this because they've offered people a discount and people still don't pay in time. And then when they do pay, they still try to claim the discount. But I have also seen a number of clients who instituted early payment and prepayment discount programs, given a 5 to 10% break in the bill if you pay on time or pay within X number of days, and have had a good positive result. I used to live in a place that had an in-ground sprinkler system, and the company would give me an option to pay the full basic annual service if I paid before the end of March and gave me a 10% discount. I would do that. Why would I do that? Well, I'd get the 10% discount. And I wasn't earning that much money in my checking account for the money that was otherwise sitting there. The company did it because I didn't have to worry about hounding people for receivables, and they got cash in what was otherwise a relatively slow cash inflow period for them. So those can be very effective for you. Also, You might consider getting credit card authorization from regular customers and charge the credit card after the invoice is approved. But make sure you safeguard that information if you get it. And if you're a service provider, you could also consider using mobile payment apps. I had a fellow who used to clean fireplaces where I used to live. And when he came, he had his little square, and he would take credit card payment as soon as the service was delivered. Yes, he had to pay a fee for that, but he had made the calculation that that fee was well worth not having to worry about chasing people to get receivables paid and getting the money much faster. So it's a valuable thing to consider. If you're in the construction business and you have bigger projects, make sure you work out an upfront payment schedule that works for you. You should be getting paid for supplies instead of you're having to lay out the cash. And you should make sure that you're getting progress payments and get it as effectively as you can. Other working capital tips. I described before what working capital is. It's a fancy financing term for the current assets compared to your current liabilities. You should avoid overbuying inventory, supplies, equipment, etc. We've talked about that already. Every time you're making a major purchase decision, you should do that with the impact on your cash flow forecast in mind. And pay your accounts payable on time, but don't pay them early. I know that everybody wants to be a good customer and maintain good relationships with suppliers, because as a small business owner, it's hard to maintain good relationship with suppliers. But if somebody has given you terms and letting you pay in 30, 60, or 90 days, pay them in 30, 60, or 90 days. You don't have to pay early. You'll still be a customer in good standing, and you don't know what's going to happen to that cash or your cash needs in the interim. So you don't want to be the one sitting there slapping themselves on the forehead saying, oh, I wish I hadn't cut that check. I could really deal with this other problem now. So pay them when they're due, not early. And do not use tax withholdings, that's employee tax withholdings or sales or meals taxes, as your cash. I have actually seen clients do this. They have hit a rough spot. They said, okay, things are going to get better. We'll be able to pay this back later, and we'll use these monies as opposed to turning them over. That is a mistake. You can be liable for significant fines and penalties, including criminal penalties, if you don't pay those sums over to the appropriate authorities as and when they're due. So do not consider that to be your money. It is a big, big mistake. Financing. And what do I mean about financing? That's really, where do you look for loans? Where do you look for investments? What are your sources of money to put to work in your business? Well, you always hear people talk about family and friends. What does that mean? It doesn't just mean the people who are sitting around your Thanksgiving table with you. It's the people in your circle. Who are you comfortable talking to about the business that you're in, the business that you're seeking, and whether there may be an investment opportunity? You also have your personal savings and your assets. Now, these can include retirement assets, but there's a risk associated with that. You need to sit down and think very clearly about what level of your personal assets you are prepared to put at risk in your business. You may have accumulated over the years a nest egg. You may not want to use that nest egg, which would be completely understandable, but you need to make those decisions and discuss that with your family and recognize that if you start using retirement assets, those won't necessarily be available to you when you want them. We've talked about credit cards. They do have high cost. If you, in fact, use credit cards for your business expenses and don't pay them back on a timely basis. But if you do pay them back on a timely basis, they can be an available source of financing that you might not otherwise have. Small businesses often have a hard time obtaining bank loans, but they are available. And particularly, my recommendation is that you think about dealing with mutual savings banks, community banks, credit unions, rather than trying to go to the big money center banks. And we'll talk some about bank financing in a minute. SBA financing can also be available. That can be loans directly from the SBA or in programs where banks make loans to you that have SBA support. If you're interested, you can go to www.sba.gov and they have a lender match program in place, or you can talk to a SCORE mentor who can recommend to you the lenders in your marketplace who are most active in making SBA loans. I talked earlier about the possibility of equipment financing and leasing, because equipment manufacturers are oftentimes a good source of credit for you in connection with equipment purchases. People talk about online lenders a lot. You know, these are entities like Cabbage and others. They are generally relatively easy to work with. They will fund directly into your bank account, but they are not inexpensive by any means. They will be associated with an online lender, usually a fee as well as interest. And if there's a short-term borrowing, that can end up being quite expensive. But they are certainly a source of working capital financing that you should bear in mind available to you. And I've also been asked many times about crowdfunding. I can tell you the crowdfunding can generally be available, but it requires a lot of work and a fair bit of time, and is usually more available like GoFundMe pages for very special circumstances. You'll always see things about health situations where people need help with medical bills and the like. Some businesses have successfully achieved funding through crowdfunding, but it's not easy. And you're going to take a lot of work and a lot of effort. But if you think you may have an opportunity to do it, I would try it, and I would try in particular in consultation with a SCORE mentor. So what is a bank lender going to look at in connection with you go in and try to get financing? It can be really difficult for new businesses, but if you have an existing profitable business, there's a good opportunity for you to achieve bank financing. What is a bank going to look at? Well, a lot of people call it the 5 C's. The bank is going to look at your collateral. What assets do you have in the business or outside of the business that can secure repayment of the loan? The bank isn't necessarily anxious to go ahead and foreclose on those assets, but they want to know that if they don't get paid, there's another source of potential payment. Most circumstances for a small business, you'll also most likely be asked to provide a personal guarantee, where you will promise to pay the loan to the extent that the business is not able to do so. That can be a daunting prospect because it means that your personal assets are at risk. And I know that the first time I had to do it, I had to sit down and swallow hard and think about whether I was really prepared to do it. Again, the bank isn't necessarily anxious to come out and sue you to try to collect a shortfall, but they want to understand that you have confidence in the business that you're in, that you are going to work hard at it, and that you are prepared to put your personal net worth behind the possibility. The bank lender will also look at your character. That doesn't mean just your education. It means, what's your experience? What is your business experience? They're going to look at your business plan and want to understand that you have thought through that business plan. You have considered the competitive factors and your likelihood of success. And the more prepared you are for that, the better your chances of success. They'll also look at your personal credit, and your personal credit rating will, in most circumstances, be something that the bank will have to be satisfied with. They'll also look at the general economic conditions and what external threats you might have, whether that's by new competition coming into the marketplace. Is there an economic downturn and likelihood that might affect your projections? They'll look at the ability of the business to repay, both the historic performance and the forecasted, and they're going to look at what equity is in the business. What is the protection against unanticipated performance negatives? Tips. I highly recommend that you establish a banking relationship early on, even if you're not getting a loan. Remember, I said you should establish a separate bank account for your business. Well, when you go in to establish that account, don't just sign the papers and give them to a teller. Try to meet with a bank officer to explain what you're doing, what your business is, and begin to craft a relationship. Again, I said it's best to deal with local banks, local savings banks, community banks, credit unions, and the like, because it's much easier if you have some kind of a working relationship with a bank officer to go in and talk about the possibility of credit, as opposed to just a cold call where the only thing you're asking about is, will you make me a loan? I would have suggested you establish merchant credit for supplies, consider working capital financing, which I talked about earlier, and make sure you're working on establishing a good track record for your future business needs. And that's really what I had to say. So Teresa, if there are any questions.
Yeah, I have a question for David or Jeff. If you're looking for a line of credit for an existing business, would you need some sort of a cash flow statement for that process?
Dave, I can jump in there and you can
Sure.
add on as stated. Yeah, if you were looking for a line of credit financing, Jim referenced it, we'd be looking at, historical financials. A lot of times it's just a tax return, business tax return. Occasionally it might be an accountant prepared statement, but that would include the balance sheet, the income statement, and oftentimes a cash flow statement of some sort.
I don't have any other questions listed. So if you do have something you're thinking about right now and you'd like to get that question submitted, please do that now. We can get that answered for you.
And I'd be
Mr.
happy to answer questions that might occur to you after today's session. You can email me at jim.dannhauser@scorevolunteer.org.
Okay. Yeah, if you guys want to put your emails into the chat, I think that could be helpful. We get keep spelling correctly. Okay. And I had a question about the recording. Let me throw that into the chat as well. It will be posted on the SCORE website, but we will also send a follow-up email with that information to you so that you'll have it, as well as the link that Jim provided mid-presentation there. Okay. Well, I'm getting thank yous from everyone, so I think that we have hit the end. I want to thank Jim for giving a fantastic presentation, and considering the lack of questions, I think it's because you did a really good job explaining everything in a very easy to digestible way. So
Either
thank
that or I
you
put
very
everybody to
much.
sleep.
No, I don't think so. I don't think so. And definitely we want to thank David and Jeff from Middlesex Bank Savings Bank. Without that, we couldn't do this without them. So thank you for your sponsorship and support. And we hope to see all of you on a future webinar. Thanks.